How are high returns achieved? High risk-adjusted returns. How do you get high returns with low risk? The answer, in my experience, is investors make money most safely and most easily when they do things that other people are unwilling to do. That's the history of my career. I started Citibank's high-yield bond portfolios in 1978 when nobody else would do it, and it was considered unfiduciary and imprudent to buy an investment-grade bond. We started the distressed debt fund at TCW in 1988 when people said, "Are you crazy? You're going to buy the debt of bankrupt companies? How can that end?" Nobody else would do it. That's how you get bargains. When investors are unworried and glad to make risky investments, or worried but investing anyway because the low-risk alternatives are unappealing, which is more descriptive of the last 10 years, asset prices will be high, risk premiums will be low, and markets will be risky. That's the result of too much money and investors who are too eager. What will help us avoid the extremes of the markets? And the keys to avoiding mistakes are simple. Awareness of history, belief in cycles rather than unabated unidirectional trends, skepticism regarding the existence of free lunches. You know, there just aren't that many opportunities to make a lot of money without risk, regardless of how often they are pandered. Insistence on low purchase prices that provide lots of room for error. And attention to all these things invariably will cause you to miss the most feverish parts of bull markets. You can't have everything, which is when prices go from fair to extreme, but they will also make you a long-term survivor. And I think that's very important. You can't have it both ways. You can't guarantee participation in the appreciation in a heated bull market and be prepared for its reversal. So I wrote my first really cautionary memo of this cycle in July of 17, and I got the rare treat of turning on the TV and watching it being debated. And these are some of the things people said on TV. One guy said the story from Howard Marks is it's time to get out. And I said to him, there's only two things I would never say. Number one is get out, and number two is it's time. Because you know, our industry, our field of endeavor does not permit that level of certainty. I would never say those things. And then you can read for yourself the other things that people said about the memo on TV. But I'll read you the last one. And one guy said, I appreciate Howard Marks's message, but I think now is no more a time to be cautious than any other time. Skip a little. It says, this means that durable portfolios, hedges, cash reserves, etc., there is no better or worse time for any of these things that we can foresee in advance. That's what he said. And I take issue with all the statements up there now, but most importantly, with the last one. We're all, I assume everybody here is in the investment business. What do we do? What do you do? What is your job? Oh, it's to manage money. No. What is the job of the money manager? And the answer, I think, is that everything we do falls into one of two categories: asset selection and cycle positioning. Asset selection is trying to hold more of the things that will do better and less of the things that will do worse. And cycle positioning means trying to hold have more money invested more aggressively when the time is right, and less money invested more defensively when the timing is wrong. Positioning for the cycle. Those are the two things we do. I don't think there's anything we do that doesn't fall under one of those two headings. And accepting that there is no better or worse time for defense versus offense means giving up on the latter, tying one hand behind our back. And I think it's a mistake. I think we can, especially at the extremes, increment our performance by being aggressive at the right time and defensive at the right time. There are times for aggressiveness and there are times for caution. When prices are low, pessimism is widespread, and investors flee from risk. That's the time to be aggressive. When prices are high and enthusiasm is rampant and investors are risk tolerant, that's the time for caution. Which is this? That's the question. Very simple question. Not always easy to answer, but a very simple question. Do you agree that sometimes it's better to be on offense or sometimes on defense? Do you agree that these are the things that determine those times? Which is this? Very simple. So, the decision today, these are the questions to ask to try to figure out which this is. Are investments rich or cheap? Where do we stand in the market cycle? That's what the book is all about. How should we be positioned versus our normal risk posture? Every one of you and every client and every institution should have a normal risk posture based on your financial condition, your aspirations, your ability to stand pain, your emotional constitution, your needs, etc. That's your normal position. Where should we be today vis-a-vis our normal position? Should we be emphasizing offense or defense today? Should we worry more about losing money today or worry about missing opportunity? Now, this is very important. Every one of us in this room faces two risks every day. The obvious risk that everybody knows about and nobody likes is the risk of losing money. The more subtle risk, which not everybody thinks about, is the risk of missing opportunity. Now, you could say, Howard, I want to be sure that I don't ever lose a penny. I don't want to ever have a down day in my portfolio. I couldn't take it. I say, okay, we'll put you all in 30-day bills. You'll never have a down day and you'll miss all the opportunities. But if you say, look, I'm a young guy, I have a big risk tolerance, I know what I'm talking about here, I want to make sure I don't miss any opportunities, then we say, okay, no treasuries for you. And now you are 100% exposed to the risk of losing money. So the point is you can eliminate either risk, which puts you entirely at the mercy of the other risk, or you can balance them. And what do most people say? Well, I don't want to lose a lot of money, but on the other hand, I don't want to miss all the opportunities, so I'm going to operate in the middle. I'm going to have some risk of losing money and some risk of missing opportunity. And most of us maintain a balance somewhere in the middle, hopefully as is appropriate for our circumstances and our client circumstances. And then the next question is, vis-a-vis your normal balance of the two risks, what should your balance be today? Do you believe in trying to change the balance as the environment changes? Or are you just a buy and hold investor? And it's not necessarily wrong, because changing it is not easy to do. Or do you want to give it a try? And lastly, if you go back 10 years ago, it's a great time to be here, because February 22nd of 09, if you wanted to make a lot of money, you only needed two things: money to invest and the nerve to invest it. That's all you needed. You didn't need a lot of brains. You didn't need selectivity, caution, conservatism, discipline, patience, agility. All you needed was money and nerve. And if you had those things over the last 10 years, you've made a ton of money. Does that mean that money and nerve is the formula for success in the investment business? No, because if you had money and nerve in April of 07, you lost a lot of money. You bore the full brunt or more of the global financial crisis, and maybe you got knocked out of business. That's when you needed caution, conservatism, risk control, patience, selectivity, and discipline. So the point is, there are different tools for different climates. Which is this: money and nerve today, caution and conservatism today. And Oaktree's mantra over the last several years has been move forward but with caution. I don't think that asset prices are so high. I don't think the outlook is so bad that you should practice maximum defense. And the return for being in ultra-safe assets is unacceptably low, so for most of us. But on the other hand, I don't think that prices are low enough or the outlook is good enough to be practicing sheer aggression. I don't think there's any place for aggressiveness in today's market. So that's where we came up with this balance of move ahead but with caution, We're investing every day. We're basically fully invested and trying to stay that way, but with a portfolio that is biased toward defense, not offense. Biased vis-a-vis our norm.